A client agrees to move $500,000 of their retirement savings into a fixed index annuity or a specialized life insurance policy. They sign the physical or digital paperwork. 100% of the client's money goes into their contract. This is the legal rule of zero customer costs. No upfront fees are taken out of that $500,000 to pay the advisor. The balance starts at exactly $500,000. At this stage, the industry calls this written business or pending business. It's just paperwork. No real money has been moved and no one has been paid yet. Stage 2, the file review. Scrubbing for suitability. The advisor then uploads the paperwork into the FMO's online portal. A FMO is a field marketing organization. A IMO is an independent marketing organization. These words are interchangeable in the industry. This entity is essentially a wholesale distributor. Instead of an insurance company hiring thousands of sales reps, they hire a FMO to train, manage, and support independent financial advisors across the country. The financial advisor or producer. Producer is the legal umbrella term states used for anyone licensed to sell insurance. Insurance carrier, a massive insurance company that designs, builds, and holds the actual financial accounts, like life insurance and annuities. They take on the financial risk. Scrubbing. This is the administrative process where the FMO's operation team meticulously reviews the paperwork. They check for things like missing signatures, typos, and account numbers so the file doesn't get rejected later. Suitability. This is the legal regulatory standard. The FMO and the insurance company must review the client's age, income, and financial goals to legally prove that this specific insurance product actually fits their life. For example, selling a long-term, hard-to-access annuity to an 85-year-old who needs cash tomorrow legally violates suitability. Stage 3, shipping the capital. This is the custodian transfer. The client's money is currently sitting inside of an old investment account or bank. The company holding the money is legally called the custodian, the institution responsible for guarding and managing the assets. The insurance company sends the signed paperwork to the old custodian. The old custodian verifies the client's signature, liquidates the investment into cash, and sends the $500,000 directly to the insurance company. This is done via an outbound ACH, automatic clearinghouse, which is essentially a secure electronic bank-to-bank wire transfer. Stage 4, activating the contract. Policy insurance. Once the insurance company receives the $500,000 cash transfer from the custodian, they log it into their systems and officially issue the policy. The contract is now legally active. The insurance company puts the client's $500,000 into their general investment fund. To pay the sales process, the insurance company opens its own corporate cash reserves to distribute commissions and overrides. Step 5, the split payday. How the advisor gets paid last. Every night, the insurance company computer systems calculate compensation for that day's issued policy. The money splits into 2 pathways: the FMO cut, the advisor cut. The insurance company pays the FMO an override. This is a wholesale administrative fee paid by the carrier to the FMO for managing the advisor and checking the paperwork. Let's say the carrier issues a 2% override, $10,000. Directly to the FMO's bank account. This money is completely separate from the advisor's pay, the commission. The insurance company calculates the commission, the direct sales fee earned by the advisor. For example, 6% commission, which equals $30,000. So who gets the 6%, the $30,000 next? Well, this all depends on the advisor's license type. Path A, the purely independent advisor. If the advisor only holds a state insurance license and operates their own independent business, the insurance company sends the entire $30,000 via a direct deposit ACH straight into the advisor's bank account within 24 to 48 hours. They get paid immediately. Path B, the registered representative. The broker-dealer Detour. A broker-dealer, or a BD, is a regulated company who oversees financial advisors who sell investment products such as mutual funds or variable annuities. By law, if an advisor is registered with the broker-dealer, all of their financial transactions must pass through that company. If the advisor is also registered to sell securities, investments, federal law dictates that they cannot be paid directly from an insurance company. The money must take a detour through their broker-dealer, insurance company, broker-dealer corporate desk, deductions, advisor payroll. The insurance company sends the $30,000 to the broker-dealer's corporate headquarters. The payout grid. The broker-dealer looks up the advisor's contract agreement, called a payout grid. The grid outlines what percentage of the sales revenue is the advisor allowed to keep and how much goes to the company. The corporate cut. If the advisor is on an 80% grid, the broker-dealer takes 20%, $6,000 to cover their regulatory oversight, technology, and branding. The broker-dealer payout. The remaining 80%, $24,000, is held by the company's accounting desk. It sits there until the next scheduled corporate payroll cycle, usually every 2 weeks or every month, at which point it is finally deposited into the advisor's bank account. The advisor is officially the last person in the entire chain to see the money clear.